The summer of 2025 has brought with it a financial storm, one that's not shaking Wall Street in panic, but instead lifting it to impossible heights. Like an economic phoenix rising from the ashes of rate hikes, inflation scares, and global uncertainty, the U.S. stock market is defying all expectations. As of mid-July, the Dow Jones Industrial Average is marching confidently past the 44,000 mark. The S&P 500 is hovering near 6,000, and the tech-heavy Nasdaq isn't just holding strong, it's roaring ahead, powered by a surge of investor confidence, better-than-expected earnings, and a macroeconomic picture that looks surprisingly resilient. If you were betting against this market, you're probably licking your wounds, because in the face of everything, geopolitical tension, Fed uncertainty, and rising living costs, America's financial engine isn't just alive, it's on fire. Take a moment to breathe it in, the giants are flexing. PepsiCo, of all companies, delivered a staggering quarterly earnings beat, sending its stock flying over 7% in a single session. A beverage and snack giant isn't supposed to be that exciting, but in this market, it's a barometer of consumer strength. Then there's United Airlines raking in gains north of 4% after dropping earnings that quieted all the bears circling the airline industry. Even the financial titans, JP Morgan, Wells Fargo, Morgan Stanley, Goldman Sachs, showed up to the earnings party dressed in green. What's even more impressive is how this earnings season is shaping up as a whole. Over 70% of S&P 500 companies that have reported so far have smashed expectations, and if this trajectory holds, the quarter could deliver earnings growth above 9%. That's not just impressive, that's a statement. Underneath all the stock surges and ticker tape, the economy itself is sending its own signals, and they're hard to ignore. Jobless claims are down to 200,000, a level that screams stability, even as corporate America trims fat and tightens belts. Retail sales in June jumped 0.6%, a solid beat that confirms one thing: Americans are still spending. Whether it's on credit or confidence, the cash is moving. Meanwhile, tech stocks have found their second wind. Semiconductor kingpin Taiwan Semi helped kick off a mini-tech rally, buoyed by signs that AI isn't slowing down, and chip demand is still red-hot. With the AI gold rush in full swing, Wall Street's favorite phrase, tech-led bull market, is no longer a fantasy. It's happening in real time. But not everything is rosy in the Federal Reserve's war room. The FOMC is just days away from its July 29 meeting, and the air is thick with tension. On one side, you have Fed Governor Christopher Waller, who is sending clear signals that it's time to pivot. He's calling for a 25 basis point rate cut, pointing to cracks in the labor market, and inflation that seems to have finally gotten the memo. He's the kind of Fed official markets love. Cautious, data-drawn, but not afraid to pull the trigger. On the other side is Raphael Bostic, the president of the Atlanta Fed. He's not having it. To him, this is no time to be premature. He's warning about the lingering effects of tariffs and how global uncertainty could throw a wrench into the fragile machine that is monetary policy. Then there's Mary Daly of the San Francisco Fed, who's walking a tightrope, saying 2 rate cuts before the end of the year are reasonable, but only if inflation behaves. The Fed, it seems, is caught in a high-stakes chess match. Every move matters, and Wall Street is watching like a hawk. Speaking of inflation, the June Consumer Price Index didn't do the Fed any favors. At 2.7 year-over-year, it's still above the golden 2% target. That spike put an end to the idea that a July rate cut was a done deal. In fact, the markets have priced in less than a 10% chance of a rate cut this month. September? Maybe. But even then, the odds are 50-50 at best. Investors have moved from certainty to caution, and that shift in sentiment could have ripple effects in credit markets, real estate, and consumer borrowing over the coming months. So where does that leave us? In a weird limbo, an economy that refuses to break, a market that refuses to fall, and a central bank that refuses to blink. But there's more. Beneath all the excitement, there's a growing divide in how analysts and investors are reading the tea leaves. Some say we're in a late-stage bull market, driven more by momentum and FOMO than fundamentals. Others argue this is just the beginning of a multi-year expansion, powered by technological innovation, fiscal discipline, and resilient consumer behavior. Who's right? Only time will tell. But right now, the bulls are winning, and they're doing it loud. Let's not forget about global factors either. China's slowdown continues to rattle commodity prices, while Europe's sluggish growth has pushed capital flows into the US, boosting the dollar and driving even more foreign investment into American equities. Meanwhile, crude oil is creeping higher, with WTI flirting around the $85.00 mark, threatening to reignite energy inflation if supply chains buckle. Yet none of this seems to scare investors. Instead, it's all part of the new normal, a high-stakes, high-volatility environment where information travels fast and fortunes are made or lost even faster. And perhaps the most important development of all, retail investors are back. The so-called dumb money of the past is smarter now, armed with AI tools, market analytics, and a TikTok-driven hunger for information. Gen Z isn't just investing, they're trading options, buying crypto dips, and analyzing earnings calls with more depth than many hedge fund interns. The democratization of finance has reached a new level, and this new generation, they want action, they want risk, and they don't flinch easily. So where do we go from here? All eyes are on the Fed's next move, earnings season, and whether this market has the legs to keep running. If the S&P breaks above 6,000 and holds, we're officially in uncharted territory. If inflation drops below 2.5% in Q3 and labor markets stay tight, expect September rate cut to become reality. But if energy prices spike, credit card defaults tick up, or global markets throw a curveball, the whole house of cards could wobble. But for now, enjoy the ride. Because whether you're an investor, a trader, or just someone trying to understand where this economy is going, one thing is crystal clear. This is not the economy of 2020 or 2023. This is the dawn of a new financial era, and you're living right in the middle of it.